Good evening, everybody, and thank you so much for coming to see our economics final project and our macroeconomic recommendations.
Hello, I'm Andrew Lee, and I will be attending Johns Hopkins University.
Hello, my name is Aiden Kim, and I'll be attending Pomona College.
Hello, my name is Alex Wilson, and I'm committed to the University of Wisconsin.
I'm Andrew Leon, and I'll be attending Loyola Marymount University.
I'm David Cardenas, and I'll be attending the University of Alabama.
I'm Finn McConaughey, and I'm committed to the University of California at Los Angeles.
I'm Kevin Linares, and I'll be attending USC.
Cal Poly San Luis Obispo.
So first, we're going to start off with some of our fiscal policy recommendations. So overall, we want to minimize excess government spending. That's just the main theme. Renewable energy spending has had majorly lackluster results. There's been a massive Inflation Reduction Act 2 that has yet to truly impact energy prices, and it has really just shifted aggregate demand and price levels, while Chinese solar and EV markets currently continue to outpace the US. And additionally, with renewables, there have been very inefficient carbon credit systems, which have been sold and misused by oil companies, having similar effects on inflation. On the other side of things, there have been vast amounts of subsidies and tax cuts going towards technology and foreign aid. There have been major tax cuts and subsidies in semiconductors and AI companies through the CHIPS Act. But these companies are already receiving plenty of funding through public and private investment. And also, there's currently a $95 billion foreign aid package just approved by the government, and about $14 billion of this goes straight to Ukrainian weapons. $4 billion goes straight to Israeli missiles. But on the other side of things, $9 billion goes straight to humanitarian aid in Gaza, and $2 billion goes to Taiwanese weapons. So regardless of stances on any of these foreign conflicts, we do recommend minimizing any excess or inefficient spending that includes printing more money or expanding the government's deficit, just to really rein in inflation. And a perfect example of an expansionary policy that we would advise against would be stimulus checks that were very popular during COVID. And so now we're going to look at our monetary policy recommendations.
All right, the federal funds rate. The federal funds rate is another indicator other than the main key indicators that can provide insight into understanding the current and past economy. The federal funds rate is pretty much the interest rate between banks when they lend and borrow money from each other. The federal fund rate can help shed light on the current stance of the Federal Reserve. For example, if the federal funds rate was noticeably low, that would suggest the Fed is employing expansionary monetary policy, intending to kickstart economic growth, and vice versa. This means that a low federal funds rate points towards a recession, as seen in the 2008 recession and the COVID-19 recession, when the federal funds rate was near zero. A high federal funds rate suggests greater than optimal inflation, and that is what we're seeing right now in the current day.
So in terms of what we should do for the federal funds rate, we suggest that we should keep them as they are currently until the start of 2025, and then we think we should slowly start to cut them down until once the inflation stabilizes. And then we do not expect rates to drop soon because of persistent inflation, but we are expecting a bit of a lag effect for rates to start hitting the general public in areas besides housing and auto insurance. Once these effects take place, we expect smaller rate cuts and the possibility of a small rate cut as well during the presidential elections to boost the economy and the public opinion.
Also, now I'm going to turn our attention towards any changes in major economic indicators. So first, we're going to start off with the percent change in real GDP versus potential GDP. So GDP bounced back from a steady slowdown coming out of the pandemic, consistently outpacing other countries worldwide. But now it appears to be straightening and actually almost slowing down as interest rates remain high and inflation also remains very persistent. And most notably from Q2 to Q4 2022, real GDP was significantly lower than real potential GDP, and now it appears to be nearing or potentially dipping beneath it once again.
So touching on inflation, over the past 40 years, it has gone up and down. As seen in the first circle on the left, it's peaked in 1980 during the oil crisis, reaching 15%. And then, although it has come down on average since then, it spiked again in the beginning of 2021, reaching a high of 6.53% in February of 2023.
Now let's take a look at government current expenditures. It peaked in 2022 with $8,829 billion being spent in Q2. It's 86.4% increase from the previous year, and expenditures dropped afterwards into 2022. But then they began to rise on average. We are now at $6,591 billion of expenditures in Q1 for 2024, which is a 4.21 increase from the previous year. And for the next couple of slides, we're going to take a look at how the major indices performed since the beginning of our stock market simulation, which began in January. And our class is very familiar with how the market performed in this last semester because we competed in a simulation. So let's first look at the Dow Jones Industrial Average. Overall, we saw growth until it took a dip into the mid to late April, but recovered over the course of May and have reached record heights. And throughout January to today, there's overall growth. In addition, we see very similar paths over the last few months for all three major indices, for the NASDAQ and for the S&P 500 as well. And I want to focus the attention onto the dip in April, which was likely caused by uncertainties with the Fed's grappling, or how the federal market has been consistently fighting inflation rates over the past few years. And looking forward, analysts should be wary of rising oil prices and inflation. As we all know, oil is very important to the world's economy, and many foreign conflicts are unfolding.
So yeah, we're going to be talking about the job market situation now in the economy. Yeah, so 4 years removed from COVID has shown a cool down in the job market. Unemployment raised slightly from 3.8% to 3.9% for the month of April. However, it is the 28th consecutive month of unemployment remaining under 4%. Jobless claims, which is on the next slide, fell the week of the 17th to 222K compared to the year high so far of 232K, which shows signs of unemployment staying steady under 4%. Jobless claims the first quarter of 2024 has been on the lower side of 200K, showing further signs of stability. The average monthly change in non-farm payrolls is lacking so far when compared to other years. However, economic growth has remained solid and continues to show signs of a stable job market. So looking forward, we expect the Fed to monitor this slowing down in the economy, but overall it is still trending in a positive state, and rate cuts will not be imminent.
Sorry, I was muted there. Now we're going to look at oil prices and their effects on the economy. So as of late, oil prices, have really had a significant influence on many economic and financial sectors, and really have been heavily influenced in inflation, consumer spending, stock markets, and monetary policy. When oil prices increase, of course, transportation and production costs rise, leading to higher prices for goods and services, which harmed consumers the most. This increase in the price level can really drain economic activity, and we've been witnessing this recently. Many companies in the oil extraction industry, however, such as ExxonMobil and Chevron, usually see stock price gains during periods of high oil prices due to increased profit margins. But businesses dependent on cheap energy, such as airlines, suffers higher fuel costs, reduced profitability, causing stock prices to fall. In order to combat inflation, central banks may raise interest rates or decrease government spending, potentially slowing economic growth. And analysts should really be monitoring indicators such as the CPI, business investment trends, and employment data in oil-dependent regions to estimate the broader economic impact of upcoming oil price changes. And so now we're going to look at unexpected global events that'll have any impacts on the greater market economy.
The fluctuations in price levels can be attributed to market movements. Most recently, the Russia, Ukraine, China, Taiwan, and Israel-Hamas conflicts have mutated perceptions of these changes. The U.S. has made its best attempts at remaining neutral in these conflicts to not escalate them, but in its efforts to do so, inflation has remained persistent. In the Russia-Ukraine conflict, the U.S. has remained relatively neutral, opting to pressure Russia economically rather than on the battlefield. According to the U.S. Department of the Treasury, since Russia's invasion of Ukraine, the U.S. has enforced several trade embargoes and sanctions on inputs, especially those going towards Russia's war efforts. These efforts have led to a 14% decrease in exports and an 11% in imports in 2021, further isolating Russia from the rest of the world market. Despite the ever-increasing trade deficit between the US and China, according to the BBC, the US has implemented $250 billion in tariffs against China and threatened $325 billion in additional tariffs under the Trump administration in order to illustrate its stance against China in its conflict with Taiwan. More recently, the Israel-Palestine conflict has yet to see significant preventative measures from the US, but it has threatened the Red Sea and Suez Canal trade routes and riled up Iran, endangering key supply chains. In a summative effort to retain its position as a global superpower, the USA's inflation looks to remain at constant levels in the near future.
Thank you so much. And now we're going to turn this over for questions.